Okay. Good afternoon, or morning for our guests in Brazil. My name's Simon Davis, and I'd like to welcome you on behalf of the Brazilian Chamber of Commerce in Great Britain to this webinar focused on the Brazilian economy. In a year where the macroeconomic trends, elections, and a shifting global order have created a very interesting environment. And for anyone with commercial or investment interests with or in Brazil, understanding the country's economic trajectory is more important than ever in 2026. So I'm very pleased that this webinar brings together two distinguished economists to provide a timely and forward-looking assessment of Brazil's outlook, and we'll be exploring the interplay between domestic policy, global capital flows, and the country's position within a rapidly changing international order. So firstly, I'm delighted to welcome Luis Fernando Lopes, who I've worked with before on these presentations. He's a partner chief economist and strategist at Patria Investments based in London, and his work focuses on the global economic trends, global macro trends, capital allocation, and the implications of international market developments for emerging economies. Luis Fernando is joined by Constantin Jankso, who's an economist at Banco Bradesco based in Sao Paulo, who brings deep insight into Brazil's domestic economic dynamics, the financial conditions and policy environment. So together our speakers will be coming at it from both based in London, based in Sao Paulo. They'll be examining the forces shaping Brazil's growth prospects, inflation, interest rates, fiscal credibility, and the evolving investment landscape. They'll be looking at the political economic considerations surrounding the forthcoming electoral cycle, and they provide complementary perspectives, as I mentioned, one looking at it from the point of view of global investors and the other grounded in Brazil's domestic financial system. The way that we're going to work this is that we're going to have presentations from both our distinguished guests, which should last in total for about 30 minutes. Thereafter, we're going to have a Q&A session, a discussion, a debate, and I would encourage you all, please, to put down your questions in the chat, any questions that you may have. And when it comes to it, then I will be asking those questions on behalf of you in order to stimulate this conversation. There's going to be a bit of to and froing, and hopefully will provide us with a rich and nuanced discussion. Finally, this is intended to be the first in a series of regular updates throughout the year in this special year for Brazil, being an election year. And so we are planning on having a further update on Friday, the 15th of May, in a few months' time, which we'll be looking at how things are developing in that discussion. So without further ado, and I've already been speaking far too much, I'm going to pass you over to Luis Fernando, who will start our presentation coming at it from the point of view of the global economic, macroeconomic trends, forces, and interesting things that are happening in the world. And no doubt you'll be touching on some Trumpnomics as well, Luis Fernando. So thank you. I'll pass over to you.
Thank you very much, Simon. Thank you, Constantine. Thank you, everybody who is connecting today. I hope we are going to have a productive discussion. So what I'm going to do pretty much is set the stage for Constantine, but I would like to highlight a few key global trends that are affecting asset prices and investors' confidence around the globe. And because, of course, Brazil, the final message here is what's going to happen in Brazil in 2026. But things that are happening outside Brazil are already affecting asset prices in Brazil. That's an important thing. And probably they will play a role in the Brazilian elections 2026 and beyond. So having said that, definitely we have to talk about some long-term trends that have been around for actually decades. So they have this effect that sometimes it goes missing in the analysis, in the debate, but they are going to be there, play an active role in 2026 and beyond. And then we are going to start to zoom into short-term things, Trumponomics, then a little bit more focus on Latin America, and then what's going to happen in our view in Brazil, but then it's going to be Constantine's show. So having said that, I would like to share, I promise it's going to be just a few slides. It's going to be here. Okay. I hope everybody's seeing the slide. Is it okay, Simon? Yes, it is.
Yeah, that's great.
Okay. There is a little bit of a typo thing here. I don't know exactly. Apologies for the some letters that are not shows properly, but the message here is quite straightforward. So what we are seeing here is the global growth rate, which is basically the black line we are seeing here. So it's basically how much growth we have on the global economy every year going back to 1970. So we are talking about a little bit over half a century. And then the light blue columns is the long-term trend I would like to stress. This is the working population by age. So people around the globe aged between 15 and 65. So as a share of the total population. So going back to the 1970s, nearly 3/4 of the population was working in working age. This has very important implications for productivity, for savings, and that explains a lot why economic growth back in the early 1970s was north of 5% per year. That was the global growth story. Then you can see here there were some adverse shocks, basically oil shocks and stagflation towards the middle and the end of the 1970s. So you have seen this sharp slowdown in the solid black line. And then some interesting developments and progress in terms of economic policy. That's the so-called the Great Convergence. You see here all the shocks and the major events in the bottom of the chart. The Great Convergence was basically a combination of big economies and emerging markets agreeing on a set of stabilizing economic policies. This is basically inflation targeting, free foreign exchange floating, some sort of fiscal responsibility rules, etc. And there was also innovation. It's important, this message, because we tend to think that innovation is basically a story of the past couple of years because of artificial intelligence. That's not true. What we mean here, and we are highlighting the information age, we see actually a continuum of technological progress that started with personal computers, internet, other things that started to speed up this technological evolution. And then as a result of this combination, better economic policies and this technological innovation, the information age, we start to see the global growth stabilizing and then picking up. So there was a bottom in terms of economic growth in the late 70s, early 80s. We are talking about growth, global growth below 3%. Then it sped up to nearly 4%. And then we had a succession of adverse shocks. That's the story starting in 2008. We all know what happened in 2008. That's the global financial crisis. From which the global economy has recovered in a very mediocre path. So that's what the slowest recovery in terms of shocks we had in several decades. But the economy started to recover. And another thing that we started to see is going back to the previous growth cycle, one element of the great convergence went missing. That was the globalization. So globalization meant until the 2008 that not only the major economies developing or advanced economies, they agreed on fiscal consolidation, on exchange rate fluctuation, and things like that, free trade, etc. But in addition to that, their agendas, US agenda, China, Europe, Latin America, they were basically common agendas. They were not competing agenda, they were more on a synchronized agendas. And then these things start to crack after the 2008 global financial crisis. So well before Trump got his first mandate, you could see, for example, global trade agreements, the consolidation of the Doha round of negotiations around the World Trade Organization went nowhere. That was well before Trump. So we started to see this fracture globalization taking place, and then you got to see that after that came other shocks. Of course, there was COVID, but then what you can see here that the global growth is around 3% right now, a little bit south of 3%, so 2.8, 2.9%. That's a full percentage point is lower than we had before the global financial crisis, and much is less as half the rate we had in the early 1970s. So what we think is behind that? There is still evolution, technological evolution. There is the AI thing. It's, as we mentioned here, it's taking off. It's there. But going back to the light blue columns, the world population is aging very fast. And remember, this has very strong implications for the long term because more people aging and getting retired, they still have to eat, they have to be clothed, they travel around, but they don't work anymore. So in terms of productivity and long-term growth, this is a severe burden on the global economy. So what we are saying here, the global picture is more challenging. We like the AI story, but in our view, what the AI can do is stabilize economic growth, global economic growth, and prevent economic growth from slowing even further. So no recession, no crash, but on the other hand, we think that the AI possibilities were wildly overestimated. There is no scenario, credible scenario for us in which global growth or growth in the United States is going to speed up dramatically and we are going to see a new age. So part of what we're discussing here now it seems to be obvious given the market performance over the past couple of months. Investors are more wary of what's going to happen with the AI. So I think that we are converging to a more realistic assessment of what the global economy can deliver and what the AI possibilities are. So it's a painful process, but the fact that, for example, if you take the Magnificent Seven, the capitalization of the big seven tech stocks is over $1 trillion less than it was by December 31st. It's an impressive fact, but it's a market correction that we think it's healthy and then makes clear that the scenario for the world economy is the one we are discussing here. But there are two things that I would like to finish here before I hand over to Konstantin. So, assuming that I can change the slide, here it is. Simon already mentioned there will be Trumponomics. So probably the most disturbing fact of this new global order is that the main beneficiary of the previous economic order, the United States, became the main offender in the sense that the United States is now a destabilizer of the global economic order, which is strange because President Trump's speech that the United States under the old order was being ripped off by the rest of the country doesn't make any sense. It's exactly the opposite. So what we have here on the left-hand side is a chart showing two pieces of information. So the columns shows the sum of what is the federal budget balance in the United States plus the merchandise trade balance. So you sum the two. Of course, if the number is negative, you mean that the United States is running a fiscal deficit and a merchandise trade deficit. And then you have the line, the solid black, the darker line showing, well, if you run a fiscal deficit and you run a trade deficit, you need to finance this deficit, right? So the United States has to sell assets to the rest of the world in order to finance the fiscal deficit and the trade balance deficit. So if you accumulate these deficits over time and you have to issue more debt or some kind of assets, you tend to accumulate a net international position. That's what the solid line shows in this chart on the left-hand side. So the more you accumulate deficits, the bigger is your net investment position on the negative side. So over several years, what we saw the United States running more deficits, fiscal deficits, more trade balance deficits. So actually, this is another way to say that, another way that economists used to say that the United States, the consumption in the United States from the government and from the private sector was much beyond the United States possibilities. So they were not ripped off by the former order. They were benefiting from it because they could consume more, and the rest of the world would finance these deficits by buying US assets. So United States was not going worse off, but now President Trump wants to turn everything upside down. So no more trade deficits, there is no clear discussion about the fiscal deficit, but his economic policies are upending the global order. And the way the import tariffs are imposed and then suspended, and then everything goes to the Supreme Court, and then Supreme Court rules that the way President Trump is doing the trade policy is illegal, and then nobody knows what's going to happen. For example, the reimbursement, over 150 billion US should be reimbursed to the importers if given the Supreme Court ruling. Nobody knows exactly when it's going to take place. Plus the geopolitical considerations, the United States moving from kidnapping the president of Venezuela and then trying to annex Greenland, things like this, a little bit on the chaotic side. So as a result of this, what we see, global investors think that perhaps we should diversify our portfolio. They have been buying US assets, massive amounts over the past decades, and now they are diversifying. They are not erasing all the exposure to the United States. They are not sharply reducing the US assets in their portfolio, but they are reducing the exposure to the US. And when you reduce exposure in a global market to one country or region, you have to reallocate these resources to another part of the world. And that's exactly what they are doing. So the rest of the world, Europe, Asia, Latin America, are receiving this money that are being diverted from the US. And that's the result of this is what you see on the right-hand side. This is stock performance in 2025. So we're using here a metric, which is called MSCI. So all the stock markets calculated the same way, US dollar, total return. So it's not only the stock price change, but also payment of dividends, etc. So what you see here on the right-hand side, the best listed equity market last year, hands down, was Latin America, 40.5% in US dollar. And the United States did well. It was not a disaster. So we had 13.2%, but it was a small fraction of what Latin America delivered, emerging markets, China, a thing like that. So you could see here this reshuffle, the portfolio change. And that explains a lot what's happening in Brazil last year and still this year. But I'm not going to steal Constantine's thunder. So let's just concentrate. Remember this, the portfolio change, given the fact that the United States became a major disruptor, is going to continue. Weaker dollar, probably more capital flows to stocks in Latin America, Brazil, of course, and also to fixed income markets, probably more to finance infrastructure, things like that. So have that in mind. Now I'm heading to the end here. What could you expect? So looking forward, 2026 and beyond. So we have our own forecast at Patria, but let's level the ground here using IMF, International Monetary Fund, and the World Bank forecast. So it's basically what the International Monetary Fund and the World Bank think is the most likely scenario for the next few years. Then what you have here, starting from the left-hand side, is the global growth. Remember, slightly below 3%. Now the expectation is it should have something a little bit above 3%. So 3.2% growth is the story we are talking about. So no recession, but if you break down this 3.2%, the underlying stories are very different. So China is set to slow down significantly from 5.8% average growth to 4.1. That's a major deceleration. If you go to the next region, United States, from 2.5 to 2. So the United States is not going to grow faster, it's going to grow slower. So that also has important implications. Europe, pretty much the same story, 1.7% growth, 1.5, mild deceleration. But look here, Latin America, because we had a major slowdown in the past 5 to 8 years, Latin America is a different story. We are set to witness a growth acceleration. Part of this story is a bounce back from the deep downturn that we had in Brazil, in Argentina recently, 5, 6 years ago. But part of this story is political change. We are going to discuss the elections in Brazil, of course, but the political change that already took place in Argentina, for example, moved Argentina from a country that was growing minus 3% to a country that is growing 3 to 5%. Political change in Chile, political change that's likely to happen in Colombia, etc., are going to speed up growth in Latin America. And this is very visible in the consensus that investors have. Where should I invest? If I'm reducing the export to the US because the US became more erratic, where should I put my money? Well, there is a region in the world that, geopolitically speaking, is less bad than the rest of the world. The Latin America is rich in natural resources. Brazil, of course, this is the case, and it's likely to grow faster, not slower. So we are cautiously optimistic that Latin America can continue to receive a good chunk of this portfolio reallocation away from the US. But then we have now to focus on, within Latin America, the biggest economy, which is Brazil, and there are some economic challenges. But then I'm going to stop sharing and hand over to Constantine.
Thank you, Luis Fernando. And whilst Constantine sets up, one question I just, whilst we're just segueing from yourself to Constantine, the capital allocation that you so succinctly pointed out there and how it is shifting towards Latin America, is part of this down to globalization and a move towards regionalization? Can we expect to see this trend on an ongoing basis?
Definitely. So it's still a globalization story, Simon, but its fracture means that there is regionalization. So China still have a globalizing agenda. It's conflicting with the US, but it's very friendly towards Latin America. The same story to Europe. There is a globalization agenda, less friendly towards the US, but it's very friendly towards Latin America. So all the major players are trying to hedge their bets in terms of the major disruptor, which is the United States. But they want, for Latin America, for them, is an asset. It's not a liability. Of course, Latin America, we are talking Latin America broadly speaking. There are some regions that are what we call no-fly zone, for example, Cuba or Nicaragua, but most of Latin America is investable. And some countries that were completely uninvestable, they may become an interesting option. For example, this is Venezuela. We can discuss this on the Q&A session. So yes, definitely Latin America is already receiving more resources from the rest of the world. It's not only one region. It's not only China. No. It's more short-term and long-term capital from China, but also from Singapore and Japan, which is part of Asia. Middle East is investing more in Latin America, Europe, etc. So for the global environment, for us, Latin Americans, is not bad. The world as a whole is not doing any better, but Latin America is doing much better in a global scenario that has deteriorated.
Cool. Thanks, Luis Fernando. And with that, and you emphasize there the largest market in Latin America is Brazil, the largest economy in Latin America is Brazil. We're going to pass over to Constantine from Banco Bradesco, one of Brazil's largest banks, who will give us an insight into focus especially on the Brazilian economy. So, Constantine, welcome and thank you very much.
Well, thank you, Simon. Thank you, Luis Fernando. I mean, you're saying you don't want to steal my show, but in fact, I think one of the main messages coming out of Brazil and having gone through the last quarters and seeing how the economy has been responding is that a big chunk of the Brazilian story over the last year or so also has to do with this global environment, which, as you guys were discussing right now, has become more favorable for LATAM, for Brazil, and we are starting to see more and more flows coming in as part of this global diversification process. And let me share my presentation, but that's exactly the first story which I wanted to address when looking what's going on here in Brazil, right? So I'm just starting here with this simple chart of the BRL, and of course something which we obsess about here in Brazil. Of course, we look at what happened in the last 12, 14 months. We had a pretty significant appreciation of the BRL. It touched almost 630 to the US dollar at the beginning of 25. Now we are, below 520 to the dollar, and you think, okay, so mood regarding Brazil must have improved, and Brazilian fundamentals must be reflecting this stronger BRL and so on. What we do here at Bradesco, and please do take this exercise with a bit of a grain of salt. We try to make a decomposition of changes in the exchange rate between domestic drivers and external drivers. Of course, this is done through modeling, so you can create all kinds of caveats, and so this is not supposed to be rocket science or the ultimate answer of what's going on in the FX market right now. Just to give you a bit of a taste of what's going on here. So what the numbers you're seeing are in a sense of a BRL, and the message here is that although we had a pretty dramatic appreciation of the real over the last year and a bit, this decomposition exercise suggests that most of this appreciation is related to external drivers. So basically, this shifting environment, which Luis Fernando so competently described, right? Again, to reinforce the importance of the global backdrop, another very simple exercise here, which we do when we look at Brazil historically. So the first line of this table, just comparing, Brazilian average growth of the last 40 years or so versus global growth. And yes, Brazil has been trading the rest of the world, has been growing less than the world as a whole. Very frustrating for us Brazilians. But if you take this 45-year-old window, so I'm already excluding the Brazilian miracle of the 1970s, just looking from the lost decade of the 1980s forward, right? And if you exclude what I'm calling here crisis years, so periods where you had some domestically related or domestically driven shock that caused the economy to slow down, and we were very picky in not selecting too many instances that we call, oh, this is a crisis year for Brazil. So we looked at the effects of the debt defaults in the early 80s and again in the late 80s, the effects of the Collor Plan in the early 1990s, the dying throes of the fixed exchange rate regime in the 1990s, and then this period immediately after the consumption boom of that ended with the beginning of the second term of the Rousseff administration. If you exclude these so-called crisis years from our sample, then we kind of see that Brazilian growth tends to track very closely what the rest of the world is doing, right? So as a takeaway number one, right, is of course, yes, we have some very interesting domestic stories which I want to look into, and I think they will play probably a bigger role in the next a couple of years, particularly in the context of election and what can we expect out of economic policy from that. But the global environment remains a very important driver. And I agree wholeheartedly with Fernando. I think it's an environment where EM in general and LATAM and Brazil in particular are very favored from this trend towards greater diversification, both in terms of financial assets, but even more generally. I mean, I think you can describe it as some kind of a geopolitical diversification as well. As the old order kind of starts falling apart and new kind of order starts establishing it. And you're seeing some concrete developments. For example, how quickly we had progress on the free trade agreement between the European Union and Mercosur. This thing was dead in the water for years and years, and really nothing happened. And all of a sudden, out of the blue, a couple of months, and it was signed. Now it's going towards ratification, so it's not fully implemented. But I think this is also a reflection of this diversification. And in this sense, I think Brazil's experience over the last, I would say, 40, 50 years has been of incremental institution building, which serves Brazil very well as an attractive destination for attracting these flows of funds, of resources that are looking for diversification. I think a good way to describe Brazil over a long historical is, very gradual, sometimes frustratingly gradual reforms, but they've always been incremental, and you always kind of keep building towards the strengthening of institutions, which is basically a story we've seen here for the last couple of decades, right? And putting it in really on the scope of what's going on right now, here is a simple comparison between the Brazilian stock market index in dollar terms versus the S&P. Had this perception, okay, Brazil was lagging behind US stock prices for a long time, and so on. Flows just into the equity markets in the month of January were bigger than in the whole year of 2025, which really saw a gradual acceleration, right? Looking in 2026, you have a story about, we're in the imminence of the central bank beginning an easing cycle. I'll talk about that in a second. Historically, this is a good timing for fixed income flows, and we're starting to see that. I mean, talking to investors over the last year or so, we also had the perception that, there was a lot of interest. There's a lot of perception that, interest rates in Brazil are too high and monetary policy will have to shift in some point in time. But it was not so easy to start building up positions when you had the central bank itself telling you that, no, we're not going to cut rates. We have to wait a bit more and, have all these Well, this course has changed. The central bank kind of said, look, we're going to start cutting rates as of the next meeting in March. So we expect to see some interesting stuff happening there as well. And just continue on this historical perspective. This is a chart which I like to always keep an eye at. This is a long-term real exchange rate chart. It's the bilateral dollar real exchange rate, so not a currency basket. So just getting the exchange rate, adjusting it for Brazilian inflation, for US inflation, and prices are all in at the prices of the latest data point, which in this case is January of this year. And the point here is that, yes, the BRL has appreciated significantly over the last 4 or 5 quarters. But if you put it in a historical perspective, you get a sense that there could be still quite a lot to go. So even thinking about the currency, I mean, no, we are now starting to touch in real terms what has been the average level for the exchange rate over the last 5 years, right? If you look for this very long period, 40 odd years, almost 50 years, at current prices, the average exchange rate in Brazil is roughly 4 reais to the dollar. So, and this is the average. for this period, right? So I think we could be seeing some things happening on this front. There seems to be some room for a currency appreciation as well, depending on how things play out. Looking at the shorter term stuff, so what we're seeing regarding the economy, and I'll try to be brief here. We can discuss this further during our Q&A session. In terms of messages, we have been seeing the economy slowing down. This is a moderate slowdown. We think the biggest villain behind this slowdown has to do with very tight monetary policy. Real rates in Brazil right now are running about 9% in real terms. It's historically at extremely high level. But you do have some very large and very important pockets of resilience. I think perhaps the most important one is the job market. I think there's a very strong argument that there has been some structural shifts going on in the job market since the labor reform implemented still during the Temer administration. Maybe it was tough to see these effects because of all the noise that the economy went through since then, between the pandemic, the deleveraging, from the consumption boost of the last decade. But clearly we are operating under a lower level of interest rate, a lower level of unemployment, without this really causing, at least not so far, any relevant inflationary pressures. So it seems like your natural rate of unemployment appears to be lower than it has been historically. Be that as it may, inflation has come down quite significantly, even though the economy, slowed down only for around 3% growth to, closer to 2%, maybe moving towards 1.5% over the next year or so. Nevertheless, we do expect inflation to run very close to the inflation target for most of this year. I'll show that in charts in a second. And then we have this discussion about the election, which I think is certainly very, very important for expectations, and I'll touch this in a second. Let me just illustrate a couple of these points that I did graphically, and then I'll turn back the word to Simon, and we can go into the Q&A, right? So in terms of a gradual slowdown, looking at the key sectors of the economy, I think they're starting to become apparent. But at the same time, do note a lot. What has been leading growth over the last couple of years has been the services sector. Of course, the services sector, by definition, is labor intense, and that helps to explain a lot of what's going on in the job market. I mentioned low unemployment. We actually are basically at the lowest level of unemployment in Brazilian history, and at least so far, this has not really been generating any inflationary pressure to speak of. If you look at job creation, right, so try to filter any changes in the participation rate and all these discussions that have become very relevant in other parts of the world, particularly developed markets. We have gone through a very significant increase in the level of employment. This is the number of people working both in the formal and the informal market. If you look from before the pandemic, we moved from a job market of around 93 million, 94 million people working to today just over 100 million. So total net job creation of around 7-8 million new jobs since the pandemic. If you look at the average real wage, so in inflation-adjusted terms, there has been an acceleration over the last couple of readings, which is a bit of a source of concern also for the central bank. So we have to monitor this. But generally speaking, wages have been rising, not so dramatically. But if you consider this higher level of wages and the fact that you have the 7-8 million people working more, the disposable income being generated by the Brazilian job market has increased quite significantly in real terms. And if you add on top of that government income transfer programs, so both the Social Security system, Bolsa Familia, and other programs and so on, you look at disposable income growing on a very relevant pace over the last couple of years. It is slowing down, yes. We're coming from 3 years of average growth in real terms around 7% for this broad measure of disposable income. Last year, we estimated it would be just under 5%. We're looking at something more than 3% growth for next year. But clearly, even though we are talking about a slowdown in the economy, we do think that these job market dynamics do provide some support and some resilience for household consumption going forward. I mentioned the inflation story, and these are our forecasts. So, expecting pretty much the whole of the year headline consumer inflation to remain very close to the 3% target, which is essentially what allowed the central bank to start cutting rates. I mean, when they signaled that they would start cutting rates now in the March Copom meeting, basically what he said is, looking at the past, we've seen a convergence of inflation to much closer to the target. We've seen inflation expectations starting to move in the right direction. This alone allows us to start easing. How much we're going to ease and for how long, that will depend on the data. And by the way, we are monitoring what's happening in the job market, in particular in real wages, if they're rising faster than productivity or not. So that might have a role in how quickly rates come down in Brazil. But that rates are coming down, they are. Just to put it here in a chart, the red bars going forward are our own forecasts for the policy rate in Brazil. So coming down from the current level of 15% to probably around 12% by the end of this year. The blue bars here represent the consensus among market economists, the focus survey of the central bank, pretty much in line with our own survey. And the gray bars here represent what's priced in the local yield curve. Again, of course, a bit of a risk premium for slightly longer tenors, but this general consumption that there is quite a lot of rate cutting in the pipeline going forward, right? And then the last point which I wanted to mention before I turn back to Simon is, of course, the election itself, right? And I think what's fair to say about the election, if you look at polls coming out and so on, I think it's absolutely fair to say that it looks like we're going to have a very competitive election, right? Personally, I think looking at polls, looking at the news flow and so on, I think it's very fair to say that this election is a coin toss. Right? And this is a bit of a change, because if you look at how markets were behaving, political analysts speaking in the press and so on, I think you could make the argument there was a sense that there was a growing favoritism for President Lula to being re-elected. And it seems maybe with the latest polls, in particular, the way how rejection rates have been evolving, with both candidates running relatively high rejection rates, it seems that this thing is moving more towards a 50-50. And I think, from a market perspective, I think this is really the fair way of looking at it from today's perspective, right? So, very competitive election. We've heard very little from potential candidates regarding what economic policy would look like if either President Lula is reelected or if one of the opposition candidates win the election. In part, and we were having a chat before our conference call started, right? And I think one of the reasons why we haven't heard that much about economic policy coming from the candidates, at least not yet, is that maybe this will not necessarily be one of those elections where it's about the economy stupid. Not necessarily. I mean, given those job market numbers that I showed you, right? if I landed from Mars and looked at these numbers, and it's like, okay, yeah, so if you have an election, 6 months down the road, the incumbent is obviously going to win because you have the strongest job market in history. And the fact that polls suggest that this is not the case just underscores that maybe economics is not so much the only issue, that there are other issues going on, crime, public safety has been an issue. If you look at opinion polls broken down by age groups, particularly among younger voters, crime is starting to become an important issue, even in areas of the country that traditionally would have been very supportive of President Lula. Maybe his margins might not be as competitive this time around as they were in the past. So I think there's a lot of water to run under this bridge still. Also, everything that we say about the election should be taken with a grain of salt, because one of the popular sayings in Brazil is that Brazilian voters really only start thinking about the election after the World Cup. So we have the football World Cup now coming now in June, July. So really, until then, yes, you have this election going on thing, but how much of it is hype because we who follow this thing obsessively, or is it something that really the general population is starting to get into or not? So grain of salt should be taken with that. But I think from a market perspective, once we do start getting some more concrete sound bites from the candidates, I would say that ultimately the key issue, the key economic framework in which to analyze the discourses of the candidate has to do with the fact that Brazil has a relatively high public debt for an emerging market. Debt dynamics, particularly in this very high interest rate environment that we are in right now, are not very favorable, right? And so, the discussion is, will there be steps towards greater fiscal consolidation? Will we have continuity? Will there be slippages on fiscal policy? And I think really to get a clearer judgment on that, I think we'll need to see more concrete proposals. At this stage, I think, at least the way we're looking at it here at Bradesco, is we're assuming a general continuity of fiscal policy. What does continuity mean? Well, it probably means that public debt to GDP will take a while until it stabilizes, probably sometime in the first half of the next decade. So, if the question then becomes, is Brazil going to become an investment grade credit in the short term? That kind of fiscal outness probably will not lead to that. We would need some kind of fiscal consolidation towards that to achieve that outcome. But it's not a policy outlook that will, ring any alarm bells either. It's not like if we only stabilize debt to GDP somewhere in the, between 90 and 95% of GDP sometime in 10 years down the road, or a bit less than that, that does not mean that we will necessarily have some kind of a confidence crisis. Actually, not at all. I think this fiscal policy path can probably be sustained for several years, particularly in the context of what we see with public debt growing in pretty much most countries of the world going right now. So for now, we're working with continuity, and then let's see what the candidates speak and the election outcome to see if we have to revisit this judgment or not. Well, as a good economist, I spoke way too much. So let me bring this presentation down. And cool. Simon, let me give you, without any further ado, word.
Oh, before you go, you mentioned that the elections are a coin toss, Konstantin. Does that mean that coalition formation and congressional dynamics would be more important to economic outcomes than the presidential result itself?
I'm not sure if you can say it's more important, but I certainly think that it's equally as important. And often when we talk about the elections, we're just thinking of presidential election, and the congressional election will be important. It looks like we will have a composition of Congress which will be either similar to what we have right now, or maybe a bit of a further shift towards a more conservative leaning Congress. You know? But remember, Brazilian the legislative branch here is extremely well, we will continue having, I don't know how many political parties. So building a coalition to support the administration in the context of Brazilian presidential coalitions, right? I mean, I always like to joke, the Brazilian political system, in a way, is a presidential office with powers not too dissimilar to the US, but with a parliament that looks more like, I don't know, like the Italian parliament. So, many parties and building coalitions is often a big of a challenge. So, independently of what reform proposal we might see from the candidates, implementation is always a challenge, which explains the point I did earlier. Policy, therefore, is very incremental. You have to build consensus. This building consensus sometimes take a long time. And let me actually just use that to mention a point which I wanted to make and then I completely forgot, but which is a good example for that, which is tax reform. We've been small inside story here. My first job, something like 30 years now ago, Luis Fernando was actually my boss, right? And he'll remember that we worked at this consulting firm here in Brazil. And I remember telling our foreign clients all about, well, yes, you have all the reforms from the Fernando Henrique Cardoso administration, and they ended the monopoly of oil, and now we're going to have the Social Security reform, and we're going to have a tax reform, right? Well, the tax reform took almost 30 years. It was finally implemented, at least partially, last year. I think this has a potential to be absolutely revolutionary for the economy, although it will take a time for it to be fully implemented. The transition period is relatively long, but it could have a huge impact in terms of both reducing the cost of doing business for firms and also create a very significant incentive for greater formalization, which has implications for tax revenues and so on. But let's not go into that, at least not for now. But it took us several decades to get a consensus built in order to approve that. And that is a constant for Brazil. So whatever optimism might get, maybe we're going to have candidate, either President Lula or the opposition comes up with this great idea for reform. Yes, okay, but then getting this to Congress will always be a challenge as well.
You are on mute, Simon.
Thank you. Yeah, thanks to you both for your inputs and your presentations, and indeed your knowledge and sharing that knowledge with us. We much appreciate it. We have a number of questions. And again, I'd just like to reiterate, if you have some questions, please put them up on the chat, because we can't actually manage the straight interactions, so they have to come up in the chat and I'll ask them on your behalf. The first question from Conrad McDonald, and I think this is an interesting one, because you may like to set him correct on an assumption. Brazil's essentially a commodity exporting economy. So if the other economic regions of the world are contracting, won't that suppress Brazil's own GDP? Who would like to tackle that one?
I would like you to start with this one. When we discuss with our investors, this is probably the most glaring, I think, mistake in terms of the engines of growth of the Brazilian economy. Very simple number, take GDP, demand side. 2/3 of the economy is household consumption. Commodity exports explain a lot of things, changes in the exchange rate, inflation pressure, etc. But long-term growth is not driven by commodities. Any breakdown of growth that you can make, whatever, you can dice and slice the data. It's about domestic market, it's about level of inflation, as Constantine put out, disposable income, etc. The service sector of the economy, that one, the line that was growing the fastest in Brazil, is 2/3 of the GDP looking from the supply side. So going back to the question, is the commodity story the main driver of growth in Brazil long term? No, it's not. It helps sometimes to speed up the growth, the underlying growth of the economy, sometimes to slow down. But going to further to the point, the question is actually very good. Supply and demand. What is happening in terms of global growth? It is slowing. So you should say, well, less global growth, less demand for commodities. Yes, but there is a supply side. In a world economy that the geopolitics is getting worse, fractured globalization, less trade, more logistical bottlenecks, the supply side is not doing well. And let's not forget that we are moving from a cycle in which commodity prices were relatively low, and there was no capital expenditure to increase supply in key areas that produce commodities. That's very true for Latin America, but also true for Africa, a little bit of Asia. So, is it possible then in a global scenario that it is slowing down, the global growth is slowing down, you have higher commodity price? Yes, because there are supply side bottlenecks and there are logistical issues that prevent from supply side to catch up with a demand that even is not as strong as it was before because global growth is lower. Having said that, we are cautiously optimistic that the terms of trade for Brazil are going to improve further. They are already getting better, but the most important part of the story is not that, is what's going to happen in terms of domestic market, unemployment, credit, fiscal. That's what's going to determine whether Brazil is going to have a finally stronger or faster economic growth, catch up with the global growth, or even overtaking it, or if it's going to be like Constantine said, another underperformance compared to global growth. That would be my answer. But the question is really good.
Can I add my 2 cents on that very quickly? First, Conrad makes, if you start stop and think about it, BRL should be a commodity currency. If you think about it, commodity currency, easy. If you test that over the last, even going further back from before the pandemic, terms of trade stopped. I mean, gave you actually the wrong signal that we would expect in terms of impact on the BRL. So yes, during the 2000s and the 2010s, the BRL very much behaved as a pure commodity currency, and you would see that on day-to-day movements. But say in the second half of the 2010s and during this decade, it really hasn't worked that way. It makes sense that commodities will become important, but then you go to the second question. Okay, which commodities are we talking about? Are we talking about iron ore, which used to be a real big one? Exports of iron ore to China to be the basis for Chinese infrastructure investment. That was a big story in Brazil in the past. Maybe that will not be the only story in town for right now. Brazil is an energy producer. I think that's going to be a story you're going to hear more and more coming out of Brazil. In this world of both transition into renewables and insatiable demand for energy coming from the AI revolution, guess what? I mean, Brazil is moving towards becoming, for lack of a better word, I use the cliche, an energy superpower. And a lot of this energy is renewable, which, with added bonus there on top of that. So that will be a big issue. Brazil will remain a huge agricultural producer, right? Less growth will not really lead for so much less demand for food in globe. So yes, we look at it, but I think there's a bigger story going on there.
Cool. That leads me on to another question, a question that come from WhatsApp, which essentially, is Is the resilience of Brazil's growth model to a slowdown in China?
I can start answering this. So again, all the models that you run in terms of trying to explain a significant chunk of Brazilian growth coming from exports to China, you don't get far. So of course this is important. China has become the major trade partner for Brazil, but let's run the numbers here. I mentioned 2/3 of the GDP from the demand side is household consumption. How much is exports? We are talking about a bit over 20%. So China is very important of this chunk of this, a little bit over 20%. Yes, but what's happening here? China uh, has good vibrations for Brazil, not only from the trade side that could be affected if China is slowing down. China has become also a very important foreign direct investor in Brazil. So what's happening here, even with a slower growth in China, and it's likely to get much slower in the future, we think that China will continue, probably is going to shift more and more to Brazil, actually Latin America, but Brazil mostly, as a key provider of resources that, for example, the United States is not going to provide. Very few people realize that actually Brazil and the United States compete in the trade balance in terms of what they send to China. The United States is also a big exporter of soybeans, agricultural items, and animal proteins like beef and minerals, etc. Well, for obvious reasons, the United States and China are not going to have the same trade flow that they had before. So probably China will source more on Brazil, even with its lower growth in China. And in addition to that, for geopolitical reasons, for the booming industries like AI, it's better to invest in Brazil from China than invest in the United States from China. So we actually expect more capital flows from China to Brazil from trade, from investment, from portfolio flows than before. So even with a slow Chinese growth, that can still be a very good story for it. There is something that we may discuss here is whether Brazil wants to have that much export to China. That's a political decision that the Brazilian government has to take. But in terms of the willingness from China to trade more and invest more and send more money to Brazil, that's undoubtedly the answer is yes.
Cool. Well, that thank you. I mean, that does sort of touch on. We have a question from Sandra Sinico, and she is asking which areas are going to push the growth of LATAM in the following 5 years. And I think related to what you were saying about China, if you could perhaps both of you expand on where you see the growth areas, or you've already mentioned agriculture, you already mentioned sustainable energy. Perhaps you could embellish a little bit more just to answer Sandra's question.
Let me start, and I'll bring it back to Luis Fernando. So I think areas that we see a lot going on here. First, I think one of the, in a way, surprises, but certainly one of the characteristics in Brazil over the last 4, 5, 6 years has been a very significant increase in infrastructure investment, in heavy infrastructure investment, right? Which is mainly the result of a lot of privatizations and concessions to the private sector that were made in past administrations and in the current administration. So there has been continuity in this sense, this concessions of pockets or parts of infrastructure to the private sector, accompanied by commitments of these companies to invest heavily. And if you come to Brazil on a regular basis, you do see that. I mean, for example, as part of my job, I do travel an enormous amount around the country, agricultural areas of the country, and so on. And it's very, you can see how we went in from a country where you had very good roads around Sao Paulo and a couple of the other industrial, but once you started moving away, roads weren't that great. And now, you go further and further away from the centers, and you still find, new airports, new roads. So the so-called Brazil cost coming from logistical cost is still relevant, but it is reducing. I mentioned Brazil as an energy superpower. I think the biggest bottleneck for energy in Brazil right now is not so much energy generation, but energy transmission. Right? A lot of the renewable energy being produced in Brazil is in the northeast of the country, and of course, the chunk of demand for energy is in the south, southeast, to a certain extent, midwest of the country. Bring this energy from the north, northeast down here is challenging. You have to create infrastructure for that, and this is not nearly complete. But enormous investments are being done on this front. This will happen. The availability of this energy, might make it quite attractive for you to start creating data centers in the northeast of Brazil, closer where you generate the energy and, actually physically closer to the rest of the world. That might be an interesting thing. Another silent, well, maybe not so silent revolution is going on right now. Everybody knows about, ethanol as a fuel in Brazil and the importance that this has. But we're going through this huge investment cycle to produce more ethanol from corn rather than from the traditional sugarcane. You have these plants being built everywhere. And then, you have traditional industries. Let's stick to energy, oil. Brazil is already one of the biggest oil producers in the world. There have been these discoveries in the northern equatorial coast of Brazil, potentially as large as the pre-salt fields of Rio de Janeiro and Sao Paulo, which could increase oil production in Brazil potentially by another third, which then I think would push Brazil to top 3 or top 4 global producers. But of course, that's going to be generating and demanding a huge amount of investments. So I think this is a big part of the story. And then, God, economists really speak too much. But okay, let me point another thing, which again, this is very speculative in nature, right? But we do a lot of talking about the AI revolution and so on. Being a latecomer into parties sometimes gives you the advantage of allowing you to jump certain stages in development. You don't go through the whole, accumulation of knowledge. You just, plug in the solution at the end of the thing, and you immediately jump to a higher productivity yielding solution in the economy. So I think these transformative changes we're seeing globally, and yes, certainly there's a lot of hype going on. Luis Fernando addressed like that too, but I think the potential for rapid increases in productivity, which get all the hype in the developed economies. This also applies to emerging markets like Brazil as much so, if not more so.
Thanks. And really cool. There's another question that's come in, which it's a perennial one, but I think just for the sake of this particular presentation, and that one is to do with interest rates and why are Brazilian interest rates? What are the drivers behind the continued high level? Over to you.
Let me start this one, and then I'll hand over very quickly to Constantine. Interest rates are very high in Brazil because first you have a perennial fiscal deficit. There is a risk of lending to a government in the past did strange tricks with domestic debt, and the level is too high. So there is a premium to that. And in addition to that, let's remember economic policy of several administrations. This one is very, very, very much the case, is to speed up economic growth by expanding fiscal spending, the government spending. The government spending is too high. And then if you have to bring inflation down to a certain level, the target, and you have high fiscal debt, in addition to that, the government spending is too high, you need a lot of real interest rates to slow down the economy. So this has not always been the case. the level of interest rates in Brazil, when we had, for example, a decent story of fiscal consolidation, primary fiscal surplus, domestic debt going down. It happened during the most of the after the COVID part of the Bolsonaro administration. Interest rates were going down dramatically, long-term interest rates and short-term interest rates. So you can change the story, but if there is a will, there is a way. But it had to start with the government. And then, please, over to Constantine.
Yeah, it's the $1 trillion question, I guess. Yeah, I won't add anything I will not add anything to what Luis Fernando said. I do think that irrespective of the structural reasons, and really we could spend till tomorrow discussing the structural issues for higher interest rates. But whatever these may be, I think there's little doubt in my mind that independently of where you think would be, your neutral interest rate in Brazil, whatever, it's substantially lower than where rates are this instant, right? So in my mind, there's no doubt that there's considerable room for interest rate cuts. Whether we're going to reach, single-digit rates sometime next year, could we, move to? Are we going to ever move back to 3-4% real interest rate as the equilibrium rate? I think then we have to start discussing the structural issue. But
okay,
reaching 12% by year end and below that next year, I think it's almost a given.
Thank you. Look, we're getting to the end of our time, so I need to be a bit quick. I mean, obviously, I've already mentioned that we're going to have another presentation on May the 15th. Thank you to your support, guys. And that'll be another opportunity for people to learn more and to ask more questions. But before we go, and before I say all the normal things that I have to say, one last question, and it's a pretty quick one, and it comes from Marcelo Carvalho. And he asks, the global political landscape is changing fast. Is it good or bad for Brazil?
So, age before beauty. I'm going to start answering the question. And our view is the global order is not getting any better, but in a global order that is less favorable overall, Latin America, specifically Brazil, is in a much better position. So it's up to us to decide whether to leverage and benefit a lot from this new global order that is more challenging, or just it's going to be a tailwind that we can benefit a lot depending on the election, the outcome of the election. In our view, there is only one pending reform, as Constantine rightly mentioned. We did already a tax reform, social security reform, central bank independence. If we can just go back to what we were doing 3-4 years ago in terms of producing a sustainable fiscal story, Brazil can surprise to the upside in terms of growth a lot, even with the global environment that is definitely worse than it was before. So that would be my first take down. Please, Constantine.
Let me just take the opportunity to say hi to Marcelo, but I'll make Luis Fernando's words my own.
Mm-hmm.
Okay, cool. Thanks. I mean, it is a time there's a lot going on in the world currently. I was particularly enthused to hear some of the comments from yourselves with regard to and the emphasis that you put on the changing nature of the global economy and the impacts it's having on Brazil. I think it makes a very interesting story. However, we're running out of time, and I do need to conclude and respect the fact that you've given of your time, and we very much appreciate that. So, just to recap, we do look forward to welcoming you both and our audience to our next one in this series of events, continuing this important conversation on Brazil, which is marked for May the 15th, where we will continue this conversation. However, I would like to thank you guys very much on behalf of the Brazilian Chamber of Commerce in Great Britain, and also mentioning our chair, Vera Innes. Thank you very much for your sincere and for joining us today and giving of your time and your thoughts. We particularly appreciate that. Your analysis has helped us really understand what's going on in Brazil currently, and I think we've tried to answer as many questions as possible. We haven't answered them all. Certainly there are a couple there that have been asked, which are really quite specific, and so Lena and myself will get back to the authors, and we'll deal with them offline. And that brings me up, of course, in addition to thanking you guys, thanking Lena for organizing this webinar. And finally, thanking our audience for your engagement and those questions, which were essential in making this very interesting and informed dialogue on the state of affairs in Brazil. So again, to emphasize, our next event with the Brazilian Chamber of Commerce is actually next week on March the 3rd, where we're talking about the regulation of digital assets in Brazil. Slightly different subject, but again, one of those really interesting growth areas where Brazil is at the forefront of the growth in digital financial services and the use of digital payments, etc. So we have a wonderful presentation there from one of Brazil's leading regulatory experts on everything that's happening in that particular sequence. And of course, our next presentation in this sequence on May the 15th, Friday, May the 15th, where again, we will be updating our audience and taking their questions. So thank you all very much. Really appreciate your time. Really appreciate your questions. It's been great. Thank you, guys.
My great pleasure. Thank you, everybody, for connected. Warm regards to Marcelo Carvalho and other familiar names that I see here. Thank you, Simon. Thank you, Constantine. Thank you, Lena, and everybody from the chamber that made this possible. See you. Looking forward to see you in May.
Okay, so thank you all.
Thank you, everyone.
Constantine.
It's been a pleasure.
Bye-bye.